Good morning, everyone, and thank you, Andrew and Kevin, for inviting me to Busan to give you this market overview. As Andrew said, my presentation today is titled Markets in Motion, Finding Direction Amid Shifting Tides. What I hope to do over the next 20 minutes or so is just give you a bit of an outlook on the shipping markets, where they currently stand, and what the fundamentals look like and how we believe they will pan out at MSI. I thought I would just start things off by just giving you the headline account of where we're sitting in the shipping markets. And when it comes to headlines, I think shipping is setting a lot of headlines. Headlines are coming thick and fast. Some of these are making the mainstream press alongside the trade press. And I guess where we've really seen this come to fruition is in the course of the last couple of weeks with the announcement at the IMO, with net zero framework being delayed by at least 12 months, and that has even made very headline press news in things like the BBC, etc. And I'm sure we'll hear a lot more about that today. I think the one thing it does introduce, however, is yet more uncertainty. And uncertainty and volatility is something that we're seeing more and more within the shipping markets. A lot of the geopolitical factors that have been seen pretty much since COVID and ever since have really impacted the shipping markets. But where are the shipping markets from an earnings and values perspective since I was stood here around 12 months ago? Well, what I'm just showing you here is just the one-year TC rate and 10-year-old prices for a range of shipping sectors. And we can see there's quite a lot of red on the screen. That means that generally earnings and values have fallen over the course of the last 12 months. The sector that stands out is, of course, containers. Containers have gone from strength to strength. And we're still seeing almost week-on-week improvement. Certainly in the charter market, that isn't now being reflected in the freight markets. So where is individual sectors sitting on their relative earning cycles, and how does one sector compare to another? Now, this is just a simple infographic which is trying to depict where we see individual sectors. The one thing I would say is, I keep on mentioning this word volatility. We are seeing volatility. We will see short upward momentum and cycles within the average trends and the broader trends that are being dictated by the fundamentals. But as we can see on the chart, on the infographic, a lot of main shipping is on the left-hand side of the earnings cycle. That means that we do expect to see some weakness in the fundamentals as we move forward over the course of the next 12 to 18 months. We've got LNG, which is now past the bottom of the market cycle. We saw record low earnings for LNG at the back end of Q1. And at the top end of the market cycle, currently at the peak, we've got the containers and still some sectors of offshore. And shipping is generally still making money. At today's levels, both from an earnings and a values perspective, there is still profit within the system. This is just a simple break-even chart. The break-even levels are dictated to by the stacked bar. The dark blue is bank debt service. The yellow is daily operating costs. The red horizontal line is where one-year TC rates currently sit. So as long as there's a gap between the one-year TC and the break-even levels, there's cash in the system to pay equity, to pay shareholders, and to potentially reinvest. So now moving forward and looking a little bit more at the cargo side of the fundamentals, I think it's important to say that we're in a very different cargo growth environment today than perhaps we were 10, 15 years ago. This is just aggregated cargo growth across all commodities. And we can see that we're now in a region of a 1 to 2% year-on-year cargo growth on average. Long gone are the days when we were at 4 or 5% on average cargo growth. And that means that we need to be a little bit wary when it comes to the supply side, because we all know that supply can grow by a lot more than 1 or 2%. So this will, again, introduce yet more volatility, certainly on a year-on-year basis, if we see supply growing greater than some of these growth levels. But narrowing things down from a cargo perspective, again, focusing in on a few shipping markets, today and over the next couple of years, and comparing it to where we've been over the last 10 years, I think the positive message to be taken from this chart is that generally we're expecting to see positive cargo growth across the board, apart from a couple of sectors, but only on a single year basis. Some sectors of shipping, such as the gas sectors, LPG, LNG, we can see very strong growth rates from cargo, more so than we've seen over the average of the last 10 years. Perhaps we're a little bit more conservative is on dry bulk and on chemical tankers, where we expect to see cargo growth rates over the next couple of years lower than it has been over the last 10 years on average. Focusing now on some of the main sectors, and just to give you a little bit of a flavour of what's going on there, and starting off with the container ship market, two charts here. One is main lane trade growth, and one is key non-main lane trade growth. Now, I think from both of these charts, we can see the impact that COVID had in 2000, 2001, 2020, 2021 and 2022, where we see that sort of whipsaw action, huge growth and then contraction. But if we just focus on what's been going on over the course of 2025, we can see different trends taking place for the main lanes versus the key non-main lanes. For the main lane trades, we've seen a reduction in cargo growth heading towards zero, whereas for the non-main lanes, we've seen a lot of strength. Now, one of the reasons that we have seen some weakness on the main lane trades, and the main lane trades are the Asia-Pacific, they're the Trans-Pacific, the transatlantic trade, has of course been in and around tariffs, and certainly the tariffs that have been put on by the US onto Chinese exports. We can see on the chart on the left just how low Chinese exports have been to the US in terms of containerized goods, very firmly sat in the negative territory. We've seen some pickup in the ASEAN economies, filling some of this gap, but if we look at the red hatch line, that shows you where the Trans-Pacific trade has gone, and we're sort of at or around 0% for certainly the first half of this year. And that is a theme that we think will follow on into 2026, the tariff impact. We've obviously seen a lot of front-loading at the start of the year. We think the real sort of full force of tariffs will actually come into play next year in terms of, if we're looking at year-on-year trade growth, incremental trade growth for containers. So we can see on the chart on the right that next year we suspect to see about 2% containerized trade growth before we see that pick up to 3.5%, 4% in the years towards the end of the decade. Now that growth, however, it's important to say, will come a lot more from the non-main lane trades, and it will come from those key non-main lane trades, and it also will come for intra-regional trades, the light blue part of the stacked bar. For the dry bulk market has benefited significantly over the course of the last couple of years from stock building in China. We can see the chart on the left. It shows you the rate at which coal and iron ore stockpiles have built up in China. And we've seen some huge volumes last year, both for coal and iron ore. We don't think this will continue. Fundamentally, Chinese strategic stockpiles of coal have now reached the level which the Chinese government are happy with. And the chart on the right just shows you how the Chinese economy is moving away, quite rapidly, I would say, away from coal as a primary energy source, and is moving more towards renewables. So 10 years ago, coal made up around 75% of all energy consumed in China. We're now at around 65%, and that trend is set to continue as we see more renewables take the place of coal within China. It's not all doom and gloom for the dry bulk market. We have seen some strength in trades this year. Guinean bauxite exports are up by over 30% at the start of the year. They've come down a little bit more in the second half of this year, but they're still at levels significantly above where they were this time last year. And soya exports into China have also been very strong, partly driven by a very strong harvest out of Brazil. So for dry bulk, we do expect to see this year, in terms of cargo, it being just above 0%, but then we'll see around 2% growth year on year, very much driven by minor bulks, very much driven by bauxite and grains. From the oil market standpoint, it's another industry where actual oil consumption, a little bit like on the coal side, we're only going to see sort of relatively low consumption growth rates year on year. So the key here is where will that consumption take place? We can see on the charts on the left just how prominent that 2023 number was in terms of Chinese oil consumption, which was driven through after the COVID era. But, you know, you can hardly see China featuring on the year-on-year growth when it comes to oil demand growth this year and the next couple of years. We need to be looking at places like Africa, the Middle East, and FSU to see real significant oil demand growth. And also on the oil side, we're also seeing this change in direction in terms of where the production is coming from. Now, one of the mantras that Trump was very pleased about probably this time, the back end of 2024, was drill, baby, drill. Unfortunately, if you look at the numbers, the US haven't been drilling any more wells. We can see that on the chart on the top right. Fundamentally, it's not making economic sense in the US to carry on drilling more wells, especially when you've got OPEC actually upping production. And as we can see, pretty much month on month over the last 6 months, OPEC have been increasing production. That's reduced some of the oil price, which has opened up an arbitrage, which has meant that we've seen a lot of oil being shipped, crude oil being shipped from the Middle East to Asia, given the arbitrage that has opened up, and that's why we've seen such strength in the VLCC market over the course of the last month or so. But of course, if we're trying to look at where the positives are within the oil markets and what wins out, whether it's the cruise tanker sector or the product tanker sector, we need to focus on refineries. The chart in the top left just shows you incremental refinery additions. We can see that moving forward, a lot of these will come in places like the Middle East, in the Indian subcontinent, and in China. And as we can see from the chart on the bottom left, this is a trend that we've seen for some time now. We're seeing more and more refineries opening up in the east and more refineries shut down in the west, in the Atlantic Basin. So by the start of the 2030s, we'll actually see more refinery capacity east of Suez than we will do west of Suez, and that's the first time we will have ever seen that. That obviously changes the dynamics for the shipping markets. So if we look forward from an incremental demand perspective, although this year is relatively poor for the product tanker market, we do expect to see that market being the sort of relative winner out of products and crude as we move forward to the back end of this decade. Now, there are some very positive stories on the demand side, cargo side for shipping. I've just picked out two sectors. One of these is LNG, as we can see on the chart on the left. LNG volumes will go up by 50% from 2024 to 2030. 400 million tonnes to 600 million tonnes. So huge volumes of LNG about to hit the water. And if you ever did want a hockey stick type chart, the chart on the right is the one in shipping currently, and that's offshore wind. Even with the sort of reduction in offshore wind opportunities in the US, there are still a huge number of offshore wind opportunities out there based on current government commitments. Now, cargo tells us part of the story. I think I'm going to spend a few slides now just telling you why we can't just look at cargo on a headline level. What we really need to do is translate that cargo into how many ships we need to move that cargo. Excuse me. Why do I mean that? Well, what I'm doing here is what we need to consider is the inefficiencies within shipping. And of course, the big inefficiency that we currently have are vessels going around the Cape of Good Hope rather than the shortest route through the Red Sea and through the Suez Canal. This is just a screenshot from our new benchmarking platform called MSI Seascape, but I think it quite easily depicts and quite nicely depicts just that stream of vessels that is now going via the Cape around Africa to get to Europe and the Atlantic Basin from Asia and vice versa. If we translate that into the actual numbers, we can see that the number of vessels going through the Suez Canal is less than half than it used to be. And I think most people have forgotten about the inefficiencies in and around the Panama Canal post the drought at the back end of 2023 and into 2024. But we can see even in the Panama Canal, vessel numbers haven't got back to the pre-drought levels. And this is introducing inefficiencies. Vessels are traveling farther and potentially at different speeds. Now, what I've tried to do here is emphasize that for what happened last year. On the chart on the left, what we have is trade growth. So that's just pure cargo growth, as I was talking about at the start of the presentation, against pure fleet growth, end-of-year fleet growth. Now, if fleet growth is higher than cargo growth, that's a negative for fundamentals. Hence, we can see all of those sectors in the red. Basically, fleet was growing greater than cargo. But that wasn't what we saw last year. We saw strength within the shipping markets. And why was that? Well, if we factor in cargo growth and translate that into shipping demand growth, and we also look at available fleet growth, so we're looking, take into account that vessels don't trade 365 days a year, we get a very different picture. We see that a lot more sectors have moved right into the green sector, which explains the strength that we saw in 2024. And these inefficiencies have always been in shipping. As we can see on the chart on the left, but the thing I would say is over the course of the last 5 years, these inefficiencies have stepped up yet more with things like deviations around the Cape of Good Hope. And they're around about 2.5% more this decade than they were over the average of the 2010s. And to really sort of drum home this message, and this is something we spend a lot of time doing at MSI, hence I'm spending a little bit more time talking about it. I think the chart on the right sort of boils all this down into sort of simple numbers that I find easy to understand. At the start of 2000, if you had one deadweight in a dry bulk vessel, that could carry, on average, 9 tons of cargo in 1 year. Today, that same one deadweight on a ship only carries 6.5 tons of cargo in a year. So we've seen a reduction in efficiencies by about 30% over the course of the last 5 years. Moving on to the other side of the fundamentals coin, supply and shipbuilding. Contracting has been strong. It was exceptionally strong last year in 2024. It was the second highest level of contracting of all time. This year, contracting levels have come down, but they are still strong by historical standards and still very much driven by the container ship market. Where orders have been placed, well, China still has been captivating the majority of orders. We did think in Q2 2025, you can see that the Chinese share of orders on the chart on the right did get squeezed, and we wondered whether this was a signal of things for the future, given the USTR 301. But Q3 2025 has suggested that that perhaps was just a blip, and also we saw a lot of cruise ships being ordered in Q2, which sort of skewed the figures a little bit. But that doesn't mask the fact that the shipyards are now very, very busy. We can see on the chart on the left just how many years shipyards have orders for. So pretty much out to 2027, they're completely full. Unless you've got a very good relationship with a yard and you want to perhaps play a premium, you're going to struggle to get a delivery this side of 2028. And when it comes to alternative fuels and alternative engines and technologies, it still really does remain the case that container ships, vehicle carriers, those vessels that burn their own cargoes as fuel, LNG, LPG, are really the ones that we're continuing to see dual fuel technology being deployed in, whereas tankers and bulkers, it still remains conventionally fueled. And that will change, but perhaps it will change a little bit slower now after the announcements from the IMO 2 weeks ago. Now, although we have seen near record ordering last year, I think it's also important to sort of put into perspective just how big the order book is in the context of the fleet. Back in 2008, when we did see the record ordering, the order book equated to 50% of the vessels on the water. So that really what presented a problem for the industry basically through the 2010s, running off this order book. Today it's around 20%, which you could say is a bit more manageable, and it certainly is. The chart on the right just shows you the order book as a percentage of the aging fleet for a number of shipping sectors. I've highlighted the ones in red and yellow, perhaps where there are concerns, but you will see there's a lot of blue on the chart. That means where there's blue, there's a requirement for more ordering. Those vessels are getting quite old, there's replacement tonnage requirements, there's incremental demand requirements, but the red and the yellow we need to be mindful of because we can't necessarily scrap our way out of a bad market situation. And the final one on the supply side and shipbuilding, I thought I would just mention shipbuilding capacity. We do see this continually evolving. Shipbuilding capacity is and will remain elastic. We do expect to see more, I would say, non-traditional regions building up market share when it comes to shipbuilding capacity as we move out towards the middle of the century. Obviously, we've heard a lot about the US, but also places like India, places like the Philippines, Vietnam, Brazil. Governments there, even in the UK, governments there have all now identified shipbuilding as a strategic industry, and more money will be put into shipbuilding by governments. Finally, to try and bring all of this together by looking at earnings and values, I think it'll probably come as no surprise, given the slides that have come before, that we do think from a market balances, for a utilization rate perspective, we will see some weakness as we move forward in the next couple of years, certainly for the main shipping sectors, as we can see on the charts on screen. And what that will mean is that we will see a softening in earnings. Now, I emphasize the word softening. It's not a collapse. It's just a softening from what have been very high levels over the course of the last few years. And if we compare a view of 2025 and 2026 in the chart on the right versus the historical averages, we can see that in 2026, in almost all cases, 2026 earnings will be above those historical averages from the 2010s and where we're up to date on 2020s. New building prices, we do think will fall. They have fallen a little bit already. And why do we think they will fall? Well, fundamentally, it's the fact that we're going to see more deliveries than we will new contracting. Container contracting has been strong and it's gone on for a long time, but it can't go on forever at the levels that we've seen. We're seeing very high order books of things like LNG. So if we're trying to look for other sectors that are going to fill the order books, it's quite difficult. So once order books start slipping, the only thing that the yards can do is reduce pricing to try and attract new orders, and we do think that will come. Again, it's a softening of new building prices, it's not a fall, and as we can see on the chart on the right, it's not even getting back to the levels that we saw in 2021. Finally, on the second-hand values, I would say have remained very sticky. They've remained potentially higher than you would expect. I mean, this chart just shows you the progression of asset prices over the last few years. LNG, a sector where we've seen all-time record low in terms of earnings, if we look at the asset prices, they've hardly moved. So I would say that asset prices are remaining quite strong. Also, very much on the dry bulk sector too, we're seeing strong asset values when you compare it to earnings. And that's also dictated or borne out if we look at where market values are today versus our calculated discount cash flow values. We can see for the main sectors, we think that the market value is potentially overheated today based on where earnings and values will be in the future. Not so much on the specialized sectors, but certainly on the main sectors. So we do think we will come a period of a readjustment for second-hand prices. This is just a simple box and whisker plot. The box and whiskers just show you the historical distribution of asset values. The red circle shows you where asset values are today, and the green circle shows you where we forecast them in 2028. The green, admittedly, is always below the red. The one point I would say is that if you look at the position of the green circles, they still remain, apart from containers, which is a slightly different beast because this data goes back to 1990 and the container ship industry was very different back in the 1990s. But generally, the green circle remains at or above that historical median. So finally, as I like to do at Marine Money presentations, is just say where we think where today's best value is from an investment standpoint, running a number of sectors through all the various MSI models. And what the exercise I've done here is say, well, we're going to go out to the market and we're going to buy a 10-year-old. And we either buy it today or we wait until Q3 next year and we buy it then. And then we trade that vessel for 5 years, and then we sell it at the back end of that 5 years. What sort of IRR returns can we get? Well, the underlying message from this slide is, given that we do expect to see some softening in asset prices, it's probably better to wait unless you've got captive cargo, unless you've been able to fix in a charter rate for a significant period. But there are certainly still positive returns to be made in shipping throughout a market cycle. So that was everything I had to say. I will be around today, so if anyone does have any questions, then do please come and find me. Thank you.